Welcome to the World of DaaS, a show for data enthusiasts. I'm your host, Warren Hoffman, CEO of SafeGraph and GP of Flex Capital. For more conversations, videos, and transcripts, visit safegraph.com/podcasts. Hello, fellow data nerds. My guest today is Elad Gil. Elad has invested in companies including Airbnb, Coinbase, Pinterest, Stripe, Gusto, Rippling, Deal, Instacart, and Square, mostly at the very early stages. The company he founded, in Color Health, is worth over $4 billion. And he's also the author of the best-selling book, High Growth Handbook, which I highly recommend. I loved. Elad, welcome to World of DaaS.
Thanks so much for including me today.
I'm really excited to dive in. Now, you've invested in a ton of super successful companies early on. What do you think? Is there any non-obvious traits that they share?
There may be two, and I think they probably sound obvious, but maybe they're not obvious to some people. Um, I think the first one is that one of the pieces of conventional wisdom in Silicon Valley is that, you have to grind for years and years and years before something works. And most of the things that I've been involved with that have become very successful started working almost right away, pretty
It
quickly
just
after
got the
launch.
product market fit and it just worked.
Yeah, it just starts working and it just starts scaling. And there's obvious counter examples of that where people pivoted or changed what they're doing or edited things down. But the reality is, most things once a product was generally available, they just started ramping. And it could be that they ramped users without having payment or anything like that, or it could be, they wandered for a little bit and then restarted. But then the second the thing that they restarted on, it worked. It really worked. And so I think that's one thing. And then I think the second thing is I feel like startups are almost definitionally an exercise in working on what's non-obvious, because if it was obvious, everybody would be doing it and there'd be no startup opportunity, right? And so it's this interesting mix of doing something that's a little bit non-obvious and at the same time just having it work really fast.
What do you think, the mistakes that maybe you've seen other angel investors make?
Yeah, I mean, I've made a ton of mistakes myself. So I don't know whether I'm the best source for things to avoid, but I think each person has to find their own style or approach to investing. And I think people will give sort of generic advice on this is how you should do things or how you should approach things. And it may work really well for the person giving the advice, but really poorly for everybody else. So I'll give you an example. Like, my style of investing is very product market centric, right? I think founders are incredibly important. I've started two companies myself, but fundamentally I view everything through the lens of product market fit. And, is there a clear market pull and do people really want this thing that you're building? Other people index on team and they do great as investors, and other people actually index on. I have one friend who's a very successful investor, and he basically asks the question of, do I think this is a really strong technical team? If so, I'll invest. Or do I think that I think it's a really interesting problem? And if so, he'll invest. And so his approach is very different from mine, but he's a very successful investor. So I just kind of feel like you have to find the style or approach that works for you versus like a generic thing that works for everybody.
Now, if I think of me personally, I'm a fairly prolific angel investor, but I think you've been at least 5 times, probably more successful than I have in angel investing. What do you think even experienced angels can learn from your experience?
I'm not sure is the honest answer. I think one of it is, again, this focus on product market fit and can you validate that the thing is actually needed by users? And some people do that and some people don't. So the people who do that, they probably don't have much to learn from that. I think the second thing that a lot of angels don't do, that I think you do, but I know a lot of angels don't, is double down on the things that are working. So keep investing along the way, assuming you're still helpful to the company. And investing in Stripe at 500 million is still a great investment,
Yep.
And so I think too many people kind of stop just after the seed because they're like, oh, the seed's over and I'm done. I think the flip side of it is a place where I've seen people go really wrong on that is I think the way that you think about an early stage company is very different from a late stage company, right? Early stage is there some inkling that I think this could turn into something that people will want, and are there good founders? Later stages is often just looking at metrics, right? You're saying, what is a TAM? How defensible is this? How well is it growing? What's the LTV CAC? Just what are the core things that suggest that this thing will really work? And I think where early stage investors go bad on the later sides, if they decide to participate, is they view it the same way they view an early stage investment. And they're just like, do I like the team? And nothing's changed on the team, so you probably still like the team,
Yeah.
but it may be a terrible business. And so I think fundamentally,
Or high priced or something at that point. Yeah.
yeah,
Interesting. On your first point, yeah, Peter Thiel always says the investment that he wished he made that he didn't make was investing more in Facebook at 100 million pre. He did the 10 million deal, and then when Excel came in, he kind of he kind of ratcheted back, and he's like, that's where he could have made a lot more money if he had doubled down at that point.
Yeah, absolutely. And I think that's one thing that people forget. And the other thing is, one could argue on a risk reward basis, it may be better, right? It's actually less risky as you get more and more information. And maybe your return is capped a bit more, but you could also potentially invest more money at the same time. So you may also get a better overall dollar basis return. So I think that's worth
Yeah,
thinking through as well.
absolutely. What do you think now that we're moving into let's say a slightly different environment than we've had in the last 15 years where we're having higher interest rates, how does that affect what we should be looking at when we're investing?
Oh, I mean, I think we had this really interesting run, right? Where for almost 20 years, tech was only up and to the right. And the great financial crisis, I don't think was really something that impacted technology companies very much, particularly startups. I was actually running a company at the time as founder and CEO of a company called Mixer Labs. It's Sequoia backed. And I was at that famous Sequoia, rest in peace, good times um,
Yep.
presentation in 2000. I don't remember, it was 2008 or something. And the great financial crisis was happening. They're like, everybody, button down and like, it's going to be a rough ride. And then it was a nothing, right? For
Yeah.
most technology companies. And so we've had 20 years of good times. And I think it's more thinking through the lens of there's a lot of excess that comes when things are working too well. And you saw that excess in terms of fundraisers. You saw that excess in terms of employee behavior. Like everything was very tight because everything kept working. And I think particularly over the last few years, because of COVID, we did all sorts of really odd things in terms of printing money and airdropping it, and creating inflation and all these things, and then counteracting that. And so I think that led to extreme sort of bubble behavior. And now we're living through the aftermath of that. And effectively, we have this cohort of companies that should have probably gone under or sold that kept going over the last 4 or 5 years. And so we have a giant backlog of stuff that just needs to be kind of cleared out, because it used to be that you'd invest in 10 companies and, 5 to 7 of them wouldn't work, right? Um, and then suddenly we went from that to everything kind of working for a prolonged period of time because people could keep raising money and keep going. And I feel like we're just kind of resetting back to like 2017 or something. Like, I actually don't think we've hit really bad times quite yet. I think next year will be much worse than this year. But I think that means, fundraisers get a little bit longer. I think the average founder has gotten much stronger and more driven and less status driven and more driven on wanting to build something useful. So I think there's been all sorts of shifts that are probably positive shifts in terms of that next wave of great companies being created. But I still think there's a lot of backlog on the excess of the last few years that will have to get cleaned out. And that's coming, over the next 12 to 24 months.
You've written a couple of pieces on layoffs, and you have this piece where almost all layoffs are between 10 and 15%. Usually they're like 13%, because like, yeah, well, you have to do at least 10, but 15 just seems like too much to do. Is 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 a good like in some ways, would you love to see deeper cuts or multiple, or how do you think about it when you're thinking about these companies that need to be a little bit more right sized?
Yeah, I think it obviously varies a lot by company. I think some companies shouldn't cut right now, they should just be growing, right? Or
Yeah.
maybe honestly, the companies that I know of that type still kind of are doing 10% through performance because they hired less well over the last couple years. And
So it's just a way of it's just maybe a more humane way of cleaning it out a bit.
yeah, and I wouldn't do it as a layoff. I would just do performance reviews,
Yep.
and just, and then they keep growing, right? And so some companies will just grow through this environment, and they should. Some companies really should maybe cut 10, 15%, although that's not very material. And then many, many companies should cut dramatically deeper. And in general, it's better to overcut and then rehire, particularly in this very good hiring environment, than to undercut and then do sequential rounds of layoffs. Because when you start doing sequential rounds of layoffs, that's when you start losing the belief of the employee base that you're actually done and that things are stable. And I think that founders are almost like, I don't know what to call it, like feral animals or something. They thrive on uncertainty and ambiguity, and they're fine with things being unstable and risky and all this stuff. But the average person you hire into a company wants stability, and they want certainty, and they want to know what's coming. And that's true whether times are good or times are bad. And so, I've had some conversations with founders where they've said, well, we're going to lay off 20%. And I'm like, well, why is it 20%? Let's run through your plan. And then it turns out they should really lay off 50%. And there's a few conversations where I've talked to people about that. And they said, well, we think laying off 50% will be too shocking to our employees, so we're only going to lay off 20%. And all they're doing in that case is kicking the ball down the road. And when they do a second layoff of 30%, people will be way more upset than if they just did it all at once, things were stable, and then they started, they were stable and moved ahead. And so I do think people are making mistakes by worrying a little bit too much about employee perception versus saying no matter what, people aren't going to like this. It's going to be a tough hit, but we can just do it once and move on versus we're going to do it multiple times, And I
It
went through
does
this
it does
experience
seem when you have
myself.
like 100 people or so, that's kind of doable because you can quickly understand who all those people are and what those people are doing and who's the most important people in the role, et cetera. When you're like at 10,000 people, like some of these bigger tech companies are, um, you may have no choice, I think, to do maybe multiple rounds of layoffs because it may be very, very hard. It's like you don't necessarily trust that middle manager to give the assessment of their people, so it might be more difficult to do it right up front.
I don't know.
Okay.
I think you can definitely identify the highest performers
Yeah, that's
and you
true.
do whatever you can to keep them. And you can definitely identify the lowest performers,
Yep.
right? Um, the
Let's say
question
top
is,
15% and bottom 15 or something.
yeah, it's pretty clear,
Yep.
right? And so then the
Yep.
question is, what do you do in the middle? And the potentially cynical view is maybe it doesn't matter that much. It matters, right? Like on the margin,
Yep.
there'll be better people and worse people and people who work harder and people who work less hard. But you should have enough trust in your managers to think they get it like 80 or 90% right. Right.
Got
And
it.
so it's really unfortunate if they don't get it 100% right. But at the same time, it's very detrimental for everybody if it takes a really long time, both from an uncertainty perspective, from the perspective of good people quitting because they don't know if they'll have a job, from the perspective of how you think about severance and can you give longer severance because you're doing it sooner. So, I could argue it's better for roughly everybody to do it faster than to um, overly worry about out of the 5,000 people or 2,000 people I'm going to let go, did I get that one person right versus the other 1,999? And it's really unfortunate if you get it wrong, but the flip side of it is like as a company, you have to just move ahead sometimes, and it's rough, right? Like these are not easy things, and I went through this experience myself where I joined a company in 2001 and it went from 120 people to 150. And then it shrank to 15 people over 5 rounds of layoffs. And I got laid off in the third round. And every time they do a layoff, I'd like pull my friend into the office and I'd like draw a chart and be like, we have to do another layoff. It's clear. Like, why
Uh-huh.
didn't they cut deeper? Right. And so eventually I got cut. And so I've been through this myself and it sucked. It was awful. Right. So I'm not
Yeah.
saying that
It would have
you
been
shouldn't
better
be
if they
humane
just cut
about
you
it.
right away. Yeah.
But it's just kind of clear that it's usually clear to the employees because they do basic math. It's not like hard math, right? You're just adding up how much you're burning and how much you're making, and you extrapolate, and you're like, well, we're not going to make it,
Yeah.
um, and then
You have a
also,
certain amount of money in the bank, you'll have a sense of like how many months you have, on burn. And, in this environment, it's going to be hard to raise. So,
yeah, and in this environment, the later you get laid off, the harder it'll be to find a job in tech because more and more companies will be doing subsequent rounds, or they'll start tightening their
good
belts,
point.
or
Yep.
as people do layoffs, they cut their SaaS spend, and so the downstream SaaS part vendors start to lose business and their NRR shrinks, and so it
Yeah.
all cascades. So
Yeah, companies who jumped on this early, let's say Q2 of 2022, right? That was kind of like when we first started to see those rounds. Most of those employees have been able to get new jobs and stuff. Whereas, like once you get to Q4, Q1, Q2 of 2023, it becomes it's more difficult because a lot of the good jobs have already been taken. There's been a lot of hiring freezes, et cetera.
yeah, next year is going to be worse in my opinion. So
Interesting.
I think the sooner you can act
2024,
on it.
you think will be worse,
Yeah,
and that's just because of this overhang that you said, or why do you think 2024 will be worse?
yeah, I think it's for two reasons. I think the big reason is, most companies that fundraised in 2021 raised 3 to 4 years of cash, roughly, right? And so if you extrapolate out that time horizon, you say, okay, that means they ran out of money in 2024, 2025. And if you need 6 to 9 months to fundraise, then you just slide that window back by 6 months in terms of when a lot of companies will be going out to fundraise. And when they start running out of money, and then as they start running out of money, you'll start to see shutdowns and more layoffs and all these things happening, right? And so I think 2024 and maybe even part of 2025 will just continue to see this slide for a lot of the mid to late stage companies in the ecosystem. early stage companies, it doesn't matter. It won't impact them. Maybe it'll just make hiring easier. And then
Yeah.
I guess the main way it'll impact them from a fundraising perspective is A, valuations will keep coming down, but B, the investor community will be very distracted dealing with companies that aren't working very well and helping them. And so they may just not have the same bandwidth to like invest in new things.
Now you've been uh, kind of popularized as kind of dual threat CEO, solo GP type of person, which is starting to get a little bit more popular. And these investors who are kind of current founders, current operators, in some ways they can help the companies more than traditional investors. That is starting to eat more market share from the more traditional VCs. Do you see that kind of continuing over time, or do you think we've reached kind of peak solo GP, or how do you think
Oh,
that
geez.
plays out?
Yeah, I feel like there's two different concepts in there. One is operator angels, and I think you got to
Yep.
that before I did, right? Like you were doing that, 15, 20 years ago, if I remember correctly. Like I remember you funding a lot of my friends back in the day. I think you and others, pioneered a lot of that stuff. And I guess you could argue that it even goes back to the very early days of Silicon Valley, right? If you read the history of the, semiconductor industries in the 70s, like all these people are angel investing in each other. So I think it's a very old concept. Um, I definitely think there's a wave of
Though some of
operators who
the
now have,
like it
yeah.
that was a lot of the operator angels like 15 years ago were writing, maybe 100K checks kind of max. Um, Even if you think of the early checks in Google, like 25 to 100K kind of max. Whereas now, like there are people who can write, multi-million dollar checks behind
hmm
it.
Yeah, that's fair. And you definitely see a lot of operators with side funds now
Yep.
of varying scales. In some cases, they're on the scale of tens of millions of dollars. And I never did that while I was operating, although I did some SPVs and things like that, in part because capital just wasn't that available. It's harder to do that. And that's shifted now. But secondly, I think I just worried about getting too distracted. And I think there's people who can balance both. I just wanted to figure out the right trade-off relative, because the bigger the check you write, the more time founders assume that you're going to give.
Yes.
Um, and so I think you have to be very explicit if you're doing that, hey, I actually won't have that much time for you, but I'd like to write a bigger check or whatever. But I think it's really valuable for founders to get funded by people who are running things simply because they have such great insights in terms of what's actually happening in the ecosystem. They may have more recent ideas on hires that people can bring on. They may have customer relationships that they can help leverage over. So, and for them, it's often
And just like the
intelligence into what's
cadence of
happening.
business changes so much every year that maybe the very big things don't change, but all like the medium things change quite a bit.
Yeah, I think that's fair. I think distribution channels shift, or how do you do distribution? What are great pools of people to hire out of changes? Like, who are the early adopter customers? Changes, depending on the industry. So I do think there's knowledge that comes with continuing to operate, and then obviously to your point, there's more universal knowledge that you either glean through years of operating, and it's like managing people is still managing people, or it's stuff that's gleaned by working with many companies and then seeing what's happening across a pool of things.
What do you expect that the market share of these both operator angels and the solo GPs will go up significantly over time, or vis-a-vis, let's say, more of the traditional VCs?
Yeah, the honest answer is I don't know. I think that there's two sort of countervailing things that tend to happen. On the one hand, if you look at many venture firms, not all, but many, there's one or two people who really drive a lot of the best investments and that founders really want to work with. And some firms have more than that, and some firms have nobody, but often
Yeah.
it's kind of like a few singular people. And to some extent, one could argue a subset of the solo GPs are basically people who would have been those singular people at one of these firms and they decided to go out on their own. Now, I think some of those people may end up going and building firms, right? Which is a normal cycle. And
Yeah.
some of those people may go and join firms or start companies or do other things. And then a very small number, I think, will keep going in the solo GP side. And then maybe there's new people who come up and sort of cycle through. And so I do think all these things are going to be kind of evolutionary in nature. I think, um, I'm guessing the landscape 5 years from now probably doesn't look that different from the landscape today. Like, I don't think there will suddenly be 100 new solo GPs driving a lot of stuff or something, but I could be wrong.
Now, you popularized the concept of founder market fit. What are some examples of like really good founder market fit?
Yeah, I think that concept may have come from Chris Dixon. I could be
Okay.
wrong. So I think actually he's the one who came up with it. And I think there are examples of that where somebody has just been working on the same thing over and over and over again at different companies, and then they decided to build it for everyone else. Like I think PagerDuty kind of started that way, where it was built internally, I think for Amazon or somebody, and then they just said, okay, we should just build this for everyone. And they already knew how to build it, and they were kind of the customers themselves, and they were, maybe early Stripe is a good example of that. They kind of built the payment system that they really wanted for themselves, as founders and as developers. So I think there's examples like that where people are just kind of attuned to what they're going to do. And then of course there's always a story of the person who like grew up in a family that was doing real estate, so they decided to do real estate tech, or they were buying houses themselves. And so, I think Eric Wu from Opendoor was kind of like that. Like I think he was already involved with a bunch of real estate stuff and he'd done Movity before.
Yeah,
And so
Ryan
it
from
made sense.
Flexport, like he was just this crazy logistics nerd.
Yeah.
Okay, really interesting. Now, when David Sachs was on this World of Desk podcast, he mentioned that he thought like growth is currently too expensive, and essentially companies should prioritize survival over growth. Like, how do you think about that trade-off?
Yeah, I guess I feel like the only good generic startup advice is that there's no good generic startup advice. And there's trends and like sets of things that you should do and all the rest. And so I think there are certain companies that should just keep growing as long as they can keep within a certain burn multiple, because now may be the time for them to go for share. And as long as they can
Yep.
keep either raising money or they turn profitable enough, they can keep going, right? And so I think if you can win a market, you should win a market. But the real question is, will you be able to keep going, right? If you take a more aggressive stance. Um, the flip side of it is most companies, or at least many companies, um, were over indexing on growth, and they were burning $5 for every dollar of revenue, or $10 for every dollar of revenue. If you're a 5-person early stage startup, that's normal. If you're a
Yeah.
150-person Series C company, that's a really bad place to be. And so I think it kind of
Yep.
depends on your context. Most companies, though, I think really overhired and really overburnt. And so you'd have companies with 2 million in revenue, raising $100 million at a billion and hiring 150 people. And then when
Yeah.
they do their layoff, they lay off 20, they lay off at 13% or whatever, right? And then they're down to 135 people or whatever it is, 130 people. And they really should be down to like 15 people, right? And that's where I think the big mistakes are being made right now.
To me, like once you get, let's say, about 5 million ARR or something like that, um, the the simple way of knowing if a business is a good business is that the CACs decrease over time. If the CACs start to go down over time, like there's something goodness about this business. But so many businesses, CACs are flat. In many cases, some of these enterprise SaaS companies, CACs go up over time, and so it's harder to justify like a bigger and bigger investments.
Yeah, I think I'd view it as CAC LTV. Like
Sure. Yeah.
if your ASP or something else keeps going up too, then
Sure. Yeah.
faster
Yep.
than great. But yeah, I agree. Like I think in general, you tend to saturate channels, and so then the question is like, is that I actually sometimes think about things as effective TAM or total addressable market. Like people often talk about your total addressable market, and they come up with all sorts of crazy numbers for it. And I kind of view it as effective TAM, which in my mind basically means what is a subset of the TAM that you can actually reach. And that's often a view of how fast are you growing, and how broad is um, uh, how broad is the set of customers that you're reaching, and often the velocity of growth is almost reflective of the size of your TAM. In other words, if you keep growing really fast, it actually means you may be in a bigger TAM than you think. And if your growth really starts to slow down, it may be a product issue, it may be a channel issue, it may just be that your TAM isn't there. You just don't have enough customers to maintain enough liquidity and growth fast enough. And I think one of the big shifts that's happened over the last decade is we went from a situation where it was very, it used to be that you'd show up with 100K of ARR growing, 15% a month or 20% a month, and you knew that there was product market fit because you're like, wow, this thing is actually working, right? And it was harder to reach people on the internet. Now there's so much liquidity and there's so many people online that you can find 100K of ARR for almost any type of thing.
Yes.
And so it's more misleading because you don't know how quickly that will tap out because the liquidity to reach customers is so much faster. And that means that you can get more traction early and then just completely flatline.
There's also certain businesses that just by the dint of what that business is should have a much higher market share. Whereas like a lot of these traditional SaaS companies, like it might be really hard to get to, like the leader might get 20% market share and number two is 10, number three is number maybe two is 15, number three is 10 or something like
Hmm.
that. But there are these businesses where the leader has like 60-70% market share because there's some
Hmm.
sort of network effect going there. So even in a smaller TAM per se, you could get an outsized return.
Yeah, I think it just comes down to, and to some extent, again, that could be an argument of like effective market size, right? If you can really saturate something to 80%, for some markets, that's better than being, you know, uh, uh, 80% of a small market may sometimes be better than 10% of a big market, but it goes both ways, right? Like there are
Yep.
other circumstances where, if I had 5% of global whatever, that's actually huge,
Yep.
like global travel spend or whatever it is.
Though if you do have 80% of a market, your CACs are going to be really low because by default, probably most people are just going to go with you at
Yeah.
that point.
Yeah. The other
Now,
thing
if
that
you were,
people, yeah, sorry, go ahead.
no, go ahead.
I was going to say, I think there are also some markets where once you hit a certain amount of market share, there's an elbow and you accelerate. Like I think there are certain consumer markets where you cross it, I don't know, it's like 10% or something of market share, and then suddenly you'll grow faster because of either a network effect or word of mouth or some other aspect of it. And so I think that's sometimes under discussed as well. That there are sometimes these scale effects where suddenly things really kick in, and you're actually going to accelerate your growth for a period of time.
Well, because brand is really important, and it's very hard to build. And so one point, it's like for instance, like if I'm going to do something in like telephony, I'm just going to use Twilio. If I'm going to do something in like credit card payments, like I'm just going to use Stripe. Like I'm not, I don't even know if they're better or not, but like their brand is so compelling that I'm going to go to them first before I go anywhere else.
Yeah.
Now, if you were to release like the an updated edition of the High Growth Handbook, what do you think you would change?
Hmm. So I'm working on two things right now related to it. One is I'm working on kind of like a go-to-market and sales addendum that may then get integrated into the main book. And then I'm working on like a early stage book. So, what are all the 0 to 1 things that you do, and very tactical advice on just the early stages of starting a company. The original outline for the High Growth Handbook, was 3 times longer than the actual book itself in terms of the areas I wanted to cover. And so there's all this stuff that isn't covered on like HR and finance and, a bunch of other stuff, including sales and go to market. Um, I think I'd probably add a pandemic response section since it
Yep.
predated COVID. I think the other thing that isn't really touched upon, and I was going to put it in and then I didn't, was like, what do you do in hard times? How do you do a layoff for the first time, and how do you communicate it, and how do you figure out what to do there? Or, how do you think about burn relative to things like burn multiples or other things? So I think it's kind of light on those sorts of areas that I would.
Well, that might be in the low growth handbook too.
Yeah. Well, I think it's also like almost every company that's really made it has had a few existential crises along the way or some big thing happen.
Yes.
So I think you know, most companies don't just grow indefinitely. They have some periods where, Facebook, it saturated colleges and it kind of flatlined. And then they did, the platform and it grew for a period and then kind of flatlined. And, they kind of went through these like waves, right? And so I think often you have these moments where you're like, wow, okay, everything's kind of slowed down. What do we do next? And some companies really figure it out and some don't. I think in general, one key thing I've learned over time is that companies that innovate early tend to keep innovating, and companies that innovate late never innovate again. And so eBay never really came up with an act two.
Yep.
And there's a bunch of other companies like that that are more modern examples. And the flip side of it is like Stripe has come out with like a dozen products, right? And so I think that people who end up launching products reasonably early in the life of a company keep launching products, and the ones that don't just kind of forever have their initial product.
Is there a sense where like it's also related to whether it's founder driven or not?
I think founder driven companies in general tend to have more capacity to innovate over time, but I don't think it's necessarily 1 to 1. Like I can look at YC companies that have done well, and a subset have kept innovating and a subset haven't. And in all cases, they've been founder led the whole time. Um, and so I don't think it's necessarily one to one. I think the other thing that happens with CEO transitions, where people I think often make mistakes, is the founder CEO will often have the person who complements them well as the next CEO. So they're like, I'm the scattered person coming up with great product ideas, and there's this person who runs the ships very well. So that person becomes the next CEO, and then you just don't innovate for the next decade, right?
Yep.
And so,
Yeah,
you
it's usually the case where like they're the yin to the founder's yang, and they're really good at the things that the founder isn't good at. But the reason why the company is so good is because it's got that founder personality. And if the founder leaves, they should probably go down to like the sixth, most senior person in the company, and not the number two person. And reason that they don't is because that number two person is going to leave, and
I
that
think it's
obviously that
okay
number
if
two
that
person is
person
so
leaves.
essential. But
Yeah,
but
I think it's
yeah,
okay if they leaves. I mean, if they're really good at what they do, they should have somebody backing them up, right? Usually those people are
that's right.
actually very good at hiring leverage beneath them. And that's the reason they're considered so good. I think it's more like you want to hire as CEO, if you've built something really big, you want to find somebody like you to take over, not somebody who's complementary to you if you want to keep innovating. Now, if
Yep.
you're stuck in a regulatory morass and you need somebody to go in front of Congress all the time and all the rest of it, maybe it's a little bit different because, somebody who likes innovating may just not like that type of job. But the reality is, you always end up with I'm going to run the ships kind of person. And then they just kind of, they never build something new or interesting again. And then you get stuck and then things fall off a cliff and then you scramble for the person who's innovative. It's the same cycle every single time. Um, and often you have like a decade where you can just coast on the past product roadmaps and the
Yeah.
momentum of the core business, and then you hit a wall. And so I think that's kind of a lesson that doesn't really get applied. Is if you're a founder CEO, hire another founder type to run the company after you, not the ops person.
Yeah. Yep. That's really good. Now, you've also written a lot about organization structure and operational efficiency. What are some of like the best innovations you've seen in like HR and organizational structures?
I think most of the attempts to innovate there don't turn out very well. Um, and I think, keeping things
Like the
lean makes a
holacracy
lot of sense.
stuff
Yeah,
or those
holacracy
types of things.
always is just awful. But keeping things lean always makes sense, and trying to minimize layers always makes sense. And um, under hiring versus over hiring, I think always makes sense. Like, there's a few things that I think just kind of tend to work.
Yep.
Having a DRI or directly responsible individual for certain areas tends to make sense. I feel like sometimes too, you see these CEOs tell these stories of how their company is run completely different. And it's either because it fits them very well, which makes sense, right? To some extent, as CEO, you need to design the organization that works for you, not the organization that would work generically for everyone, right? So the organization should fit the CEO, not the other way around. Um,
Yes.
but I think sometimes these things turn out to be overstated. We never have meetings, and I just run it for blah blah blah. And then you talk to an exec there, and they're like, "Oh yeah, we have meetings every Monday for 3 hours." So I feel like some of these things are also almost like market positioning to sound like innovative and cool, and we're not a big company and blah blah blah. And then you kind of dig it in, and you're like, well, they kind of actually really run it the same, roughly within the ballpark of some constraints, right? But again, I think people should kind of design the thing that works well for them versus the thing that's generically supposed to work.
One of your passions is investing around life extension. For you personally, outside of like sleep and diet, like what do you think? What do you think people should be doing, or what are you doing that's interesting?
I am doing nothing interesting, honestly. So I've tended to take a very conservative approach to all this stuff. I think it's sleep, it's diet, it's exercise. I think there's some basic things that just make sense to do.
Just the basic
Um,
stuff that everyone
yeah,
says to do.
yeah. I mean, those tend to seem to correlate with at least health span. There are people that I know in the anti-aging community, and they tend to take like a baby aspirin. Some of them take a certain subset of types of statins, which tend to help with obviously cardiovascular disease, but in some cases inflammation and potentially I think some neuro stuff. And then the more experimental people maybe take like some metformin or something, where the effect size is small but it looks real. But in general, I don't do anything radical, and I'm kind of waiting for a real generation of anti-aging drugs
And
to
what are you
come out.
excited about? Like, what do you think could happen in the next 15 years?
Yeah, there's sort of what could versus what likely will. And I think
Okay.
part of that is regulatory. I think part of that is a number of companies being founded in the area. I think part of that is just structural issues in biopharma. Let me ask you this. When was the last time that a 40 or $50 billion plus biopharma company, biotech or pharmaceutical company was started outside of Moderna, which I view as almost like an accident of COVID?
It's a good question. I don't know.
The last time I looked, it was the late 80s. It was Regeneron. And I don't
Wow.
remember when Vertex was started, but I think Vertex got there now too. So, but it's been a good like 30-ish years, right? 30 something years since, very large biotech companies have been started. And you start to ask, why is that, right? Similarly, if you add up all of the biopharmaceutical industry's market cap, J&J, Eli Lilly, Amgen, Genentech, et cetera, Pfizer, um, all the thousands of public biopharma companies add up to roughly the top 4 or 5 tech companies in terms of market cap. But healthcare is 20% of GDP,
Yeah.
right? And so this is kind of insane if you think about it. Why is biotech so bad at having success? And it's a long story we could get into, and that's why I'm saying, is it what do you think will happen, or what do you think should happen given what we know scientifically, right? And if it was just based on what we know scientifically, I think we would make very fast progress. Relatedly, during World War II, um, Winston Churchill wanted to treat gonorrhea in soldiers in the field. And so in a year, they rediscovered penicillin, turned it into a drug, and distributed it. 1 year. And similarly, during COVID, we got multiple vaccines done, as well as multiple drugs approved in like 9 months, and with very few adverse events, with very few side effects, et cetera, in the populations that were tested. So why can we suddenly do things in these spurts of 9 months or a year, and why isn't the norm closer to that than our current situation, right? And so I think there's all sorts of underlying
Is
topics
there,
there,
I mean,
but
there's some sense where like aging isn't seen as a crisis per se, right? So it's kind of seen as like the normal events of
yeah.
the world, and
Sure, but
um,
many
it,
diseases are diseases of aging. You don't have to launch it as an aging drug, right? But
yep,
why is it that um, outside of genetically induced cancers, roughly everybody gets colon cancer in the same age range, and roughly everybody who gets breast cancer gets it within a certain age range, et cetera? It's because to some extent these are diseases of aging, right?
yes, of course.
Um, Heart attack, same thing. And so aging is obviously a driver for many types of disease. It's actually interesting. If you removed cardiovascular disease and cancer, it only buys you another, I can't remember the exact number, 5 or 7 years of life on average, right? So even if you were to get rid of the two biggest killers, you still have all this other stuff that accumulates over time. And so you could also put it aside and say, well, I care less about lifespan, although I think that's important, and I only care about health span, and I just want people to be healthy until they're 80, and then they can drop dead or whatever, right? Even that would be hugely useful for people. And again, I think there's lots of data on things we can do there. We're just not doing very much there. So I think there's all sorts of issues that underlie it. But
Are you interested in some of these um, more detection systems? Maybe they're a little bit more low tech, whether it's like the Grail test or maybe some sort of full body MRI, or some other type of thing that can at least help us understand what's going on a little bit better.
I think those things are interesting. Fundamentally, it's kind of shocking that you get more data out of your car going to a mechanic that when a doctor sees you, right? You go to a mechanic now and you plug the data port into a machine and it downloads, I don't know how much data, gigs of data, right?
Yeah.
And then the doctor has you come in and they hit you on the knee and your leg moves and they're like, okay, you seem fine, right? And you're like, what is that? I mean, that's ridiculous. It's like, 14th century technology. Could you cough for me now while I
But
listen with this
even the
thing that
blood
was
test, I
invented
mean, you
100
get
years
this
ago?
blood test and it may have like 200 markers in there, which, for someone like me is very, very difficult to understand and then you do often like the doctor has to help you walk through it, and different doctors may have different markers that they care about. I don't know there's like an easy way I could just like upload that uh, PDF or that document into some other analysis system that could track it over time and give me a sense of types of things I should be doing and maybe mirror it to my diet, et cetera.
Hmm. Yeah, no, I mean, it seems like there's a ton of stuff that can be done. And so the real question is like, when will that stuff actually happen and what's blocking it and all the rest of it. And I actually think this is a place where maybe, the rise of AI gives an excuse for all sorts of other things to happen that have kind of been held back. There's actually a really interesting project that was done at the Weizmann in Israel where they looked at different people and their diets, and basically they found that and they put people on these continuous glucose monitors. This is a couple years ago, and they found that different people would cluster in terms of the things that would spike blood sugar, and it was kind of a reasonably consistent pattern. So if you like some people, if you eat rice, you have a big blood spike, but if you eat ice cream, you don't, or whatever it is. And so the people who spiked on rice and strawberries and pretzels or whatever were different from the people who spiked on like ice cream and peanut butter and apples or whatever it is, right? And so, there's all sorts of stuff that we could be doing either from a dietary perspective or otherwise that I think could really have a good positive impact on us. But again, we're kind of flying blind because it's not a very data driven profession.
Yeah, yeah, it's really interesting. Now, if people if people did live longer and healthier, how do you think that would like change society? What do you think like the some of these second and third order effects to society would be?
Yeah, I think it depends on the degree of life extension. If it's 10 years, it doesn't matter, right? Or it matters, you're more productive, whatever, but it doesn't necessarily fundamentally change everything. If it's 100 years extra or 500 years extra, that's radical, right?
Yes.
Because, there's the old Kuhnian paradigm of scientific change, which basically says the old guard needs to get out of the way in order for society to progress or science to progress.
Yes,
And
science
basically that usually
advances
means
one
death.
future at a time.
Yeah, exactly. And so, imagine if Stalin was still in power because he never died, or Chavez,
Yeah.
or, you can kind of go through the list. And so one could
Imagine
argue,
if Buffett could just compound for another 100 years or
yeah,
something
yeah,
like that.
exactly.
Yeah.
Yeah, yeah. And so it's kind of like, you end up locking in power structures pretty dramatically in today's world. Or the Supreme Court, it's a lifetime appointment. Imagine if our justices were from the 1800s still, right? Um,
That's good. That's really interesting to think
and
about. Yeah.
and so I just think like that's one aspect of it. So I think that shifts pretty dramatically. You have to think about renewal societally. And actually, it's interesting because if you look at, for example, the early biomedical institutions, they used to be very nimble and dynamic. And I think in part it's because they had young, effectively founders running them, right? Like the NIH, I think the original director of the NIH was like 27 when appointed, and the current one was appointed at the age of 70. Or NIAID, Fauci is like 82 or whatever, and the original person on it was like 37, right? And so you can kind of see what gerontocracy does. But
And
I
even the
think,
grants are going to old every year the average age of the
yeah, the
grants are
average
getting
age keeps
older as
going
well.
up. Yeah. And so it's kind of like, or the Senate, right? The average age is quite advanced relative to
Yep.
historical.
Yeah, or a presidency nowadays, right?
Yeah. So I think, like, in general, one could argue that turnover and renewal tends to be good for society. And if you had populations that lived for hundreds of years, A, you'd have to figure out that renewal part, but B, people would have more of an opportunity to renew themselves as well. So I think it may even be self reinforcing because if you live for 200 years instead of 80 years, the way you think about your whole life shifts. Maybe you have kids in different cohorts over time. Your career probably changes multiple times. So you have to be more nimble and adaptive. And maybe you go to school, you go through some life cycle, and then you go and have kids again, or you take another degree, or you change your job,
Yep.
or, and so you have this very dynamic life, but then you also have a very long term perspective on the world. You suddenly care about climate in a different way, maybe, or maybe you care about some other aspects of your life and so of the world, right? Or policy.
Also, marriage is interesting. I mean, to death do we part. Like one thing to be married for 50 years, but 150 years seems like a really long time.
Yeah, it depends on your spouse, I guess, but
Yeah.
I think all these things are big shifts, right? And even your relationship with your children, right? If you're 120 and your kids are 100, your relationship with them is probably very different, right?
Right. Right.
So
Then they're true peer at that point.
yeah. Yeah, so all these things I think shift in really dramatic ways societally that, haven't been explored.
You've invested in Anduril, and I know you've talked a lot about how there haven't been major challengers to the big defense incumbents, the Raytheons, the Boeings, Northrop Grumman, et cetera. What's stopping more innovative companies from getting into, let's say, like the defense and intelligence high side space?
Yeah, I think that in defense, there's traditionally been like 4 or 5 reasons that it's been harder for startups to become true giant companies. And I think number one is there often has not been a clear why now statement. And I think there's now why now statements around drones, AI, and cyber, right? So there's room for new startups to actually emerge and win business, right? Because there's a technology shift that the incumbents aren't very good at. Um, I think a second thing is that you usually it takes a very long time to get something known as a program of record. So often you see startups build and get a proof of concept trial or something else, and often these are big contracts, $10 million or whatever. But to get into the hundreds of millions of dollars, you need to land these major deals. And usually, to land these major deals, you need multiple products. You need to be able to sell a bundle versus a point product. Otherwise, you get bundled by somebody else. And most startups don't build a broad product suite up front. And Anduril did that immediately. You need capital so you can last long enough because it's deal risk in terms of hitting one of these programs of record. And many of the backers of Anduril are able to keep investing over time and support the company. And then you need some connectivity into the government. And you had like an ex Palantir team who had good foreknowledge of how do you sell to the government and things like that. So I think all those things kind of had to come together for Anduril to be successful. I think there's still a lot of room for a cyber specific company, which would be probably software only. Um, so I think there's probably a very large cyber company to build as well, but I haven't quite seen it yet.
One of the things with like Anduril is, and in SpaceX or something, is that they had these famous stars that are their CEOs that lots of people want to meet. Palmer Luckey, or you have Elon Musk at the time, and they can kind of cut through the incumbent boxing you out, and they can cut through some of the noise and get their. It's sexy to meet somebody like Palmer or Elon. Uh, but most average entrepreneurs don't have that. This may be the first time they've done it. They haven't sold a company for over $1 billion yet. They're just working on a really good product. How would you advise some of those guys to kind of cut through it?
Yeah, I think some of the founders of so Anduril had multiple co-founders. The CEO is Brian Schimpf, and then Palmer is
Yep.
the CTO and co-founder. And I think the star power definitely helps, but the flip side of it is I think it's just understanding how government works. What do they want to buy? Building something that's differentiated. Understanding that you have to engage really deeply and kind of build against existing needs because you almost have like a bespoke customer for each branch. Um, so I think it's just understanding that sales cycle really deeply and understanding buying behavior, and that would immediately lead you to saying, okay, I need to build a broad based bundle, and I need to build I need to build against very specific types of requirements, but also I need to build something that the incumbents can't necessarily do. Anduril also, I think, been really smart about its model in terms of not being cost plus. So in the defense industry, often people will charge 5 or 8% on top of cost,
Yep.
and that's their margin.
Especially like
And
for hardware or something or whatever, or
yeah,
services.
and what that means though is that they charge everything. It's like
Yeah.
the employee hours on the project or whatever, and so they have a really strong incentive to inflate price and keep things going as long as possible because that's where their margin comes from. And that's why you have $100 screw
Yep.
instead of buying a screw for 10 cents. It's because you get $5 for the screw, right? In terms of margin. And Anduril's margin is a more traditional hardware or software margin business, which means it's just a fundamentally different business model. And if you sell something for 100K and get 50K a margin instead of selling it for $1 million and generating 50K a margin, it's a better thing for the DoD. It's a better thing for the country, and it's also a really good business model for Anduril. So I think that really matters too.
Yeah, you've been writing a lot about AI. Um, how do you see the balance of power shifting between like the startups and the incumbents in the AI space?
Yeah, so I think AI is, the biggest shift that's happened in a really long time, right? And so, I've lived in one form or another through a few shifts: the internet, mobile, cloud, et cetera. And this is at least at that same level of magnitude. Crypto, I think, was a shift on the financial services side and perhaps identity side. So yeah, I think this is like the big platform change in some sense in terms of how we think about software and what it does and how it works and how we interact with it. I really feel like we're in the second wave of AI in some sense. I mean, really, there's been multiple waves throughout time, right? We had expert systems in the
Yep.
70s and all this stuff.
Machine learning
Um,
and
yeah, but I feel like the first kind of modern wave um, was probably kicked off somewhere around, I don't know, 2012 or something with AlexNet. And we had all the deep learning stuff emerge and CNNs and RNNs and GANs. And, um, And then I feel like the value of those waves all went to roughly incumbents, right? It was the Netflix recommendation engine and the Facebook newsfeed, and startups really didn't do well off of that wave at all. Like I can't think of a single startup that got really big. Um, and then in 2017, or I guess 2015, we had diffusion models invented, which is the basis for a lot of the image gen stuff we're seeing now. It's like a statistical physics model. And then in 2017, we had transformers invented at Google. And those are really the two big shifts in terms of architectures for AI that is driving all the innovation right now. And I think for the first time, we're seeing a moment in time where startups can really get a big chunk of the value. And I think most of it will still go to incumbents, but I think a really big piece will go to startups. And so I think it's a really exciting period of time.
And partially because if you get too popular, like the costs start to ratchet up pretty fast, right? On the AI side, because you have these huge compute costs that are
Oh,
somewhat fixed.
it depends on which part of it you're talking about. If it's the training side, I would really differentiate between image gen stuff on the diffusion models, which are really cheap to train. It's like 500K to a few $1 million versus transformers. The most cutting edge transformers are probably 50 to $100 million to train right now. And that will probably only go up with time. So you definitely have defensibility on the model side in terms of eventually there'll be a capital moat there, probably. But I think costs are dropping fast enough that a generation or two older will be really cheap to do. And so I think a lot of that will move to open source or companies that are going to be providing subscale models.
Yep.
And subscale may still mean it's like the equivalent of GPT-4,
Yeah, yeah.
it's just 2 years later or
Well, if you
something.
think
And
of
so,
these, like most of the semiconductor market are like semiconductors that were invented in the 80s or something, right? And but they're still really valuable because they might cost like a cent or a few cents or something like that. But you have so many of these semiconductors in your car or whatever it might be.
yeah, exactly. So I think it's going to be very similar to that dynamic. And then from an incumbency perspective, it really feels like things may eventually collapse down into some combination of OpenAI, Microsoft, Google, Anthropic, seems to have, strong models. And then there's some companies that are building their own models, but for more bespoke purposes, like character. And then I kind of wonder, what does Amazon do? What do some of the other players, Facebook do, et cetera? Do they build their own models? Do they partner? Does one of them just back open source really aggressively? Like if you go back to the 90s, Linux was mainly just funded by IBM as a counterweight to
Yep.
Microsoft. And most big open source projects traditionally have had a big corporate sponsor. And so one unanswered question is who is that corporate sponsor for open source in the AI world? And I think it could be Amazon, it could be NVIDIA, it could be Facebook, it could be Oracle. You kind of have to ask who has an incentive and who has a lot of cash. Maybe
And
it's
how do you think
Apple.
like Apple plays with all
Yeah,
this?
maybe it's Apple. I mean, Apple has never been the strongest company at ML
Yep.
or AI. And so, part of that is privacy. Part of that is just, I think it's never been their core focus or competency. And they've already done some interesting things in terms of like embedding, stable diffusion on devices and things like that. And, what could imagine a world like that where maybe they fund open source so that eventually it's just the software that they integrate into their devices. Um, but yeah, I think there's multiple players that could fund open source at scale. And the question is, do their incentives align enough for them to do that? And if so, I think we'll see that emerge over the coming years.
There's also some like regulatory barriers for basically capturing value in AI. How do you see those regulatory frameworks evolving over time?
What would be an example of that?
Well, there's the privacy side of things, so it's difficult to potentially do. There may be different other regulations where to share things. Sometimes you may have to share things across companies, but you're not allowed to do that because there could be seen as collusion, or maybe you have to put something in some other place, or if you want to attack a Google or a Microsoft or something.
Yeah, I think a lot of that stuff will really be navigable. Like I think fundamentally, the fact that um, a lot of the advancements in AI have not been driven by the really big tech companies means that the big tech companies can now follow aggressively because it's very easy for them to argue, hey, we didn't start this and it's a competitive market. And so we have to compete. And so I think it's kind of giving them permission now to kind of go after some of these areas where before I think they kind of were hesitant perhaps to launch products. And part of that probably was just internal bureaucratic processes that just block everything because some of these companies just aren't shipping effectively anymore, in part due to employee bloat or other reasons. in part due to regulatory scrutiny. And so I think some of these players hopefully will become more nimble over time. And I could imagine, for example, Facebook being very nimble on this simply because Zuckerberg is still running the company. And, it sounds like he's already starting to reorient around AI instead of AR/VR. As an external observer, at least it seems to be that case.
Now, a couple personal questions. From the outside, you seem extraordinarily productive. You write a lot. I read everything you write. I love it. You're just like you're on Twitter. You're doing podcasting. You're making these like incredible investments. You're deep thinking. You're meeting with all these people. Like, how do you have any secrets to your own productivity?
Not really. I wish I had like some productivity hacks or something. I mean, I try to make a list of what's important, and then I try to tick through the list. So I wish I had a deeper thing. Once a year, I try to do almost like a personal offsite on like what are my goals for the year and then the next couple years. And then I try to align against those things. But that's
How do you
more
avoid
like,
like doing things that are not as good? Like or doing good things like often I think there's this tyranny of like there's all these good opportunities and you have to avoid them if you want to do the great things.
yeah, I definitely don't have the full answer to that. I think that, one of the big hard things in life, I think, is early on in your career, you get rewarded for saying yes to everything. Hey, my friend needs some advice. Can you talk to them? Yes. Hey, somebody's thinking of switching jobs. Can you talk to that person? Yes. Hey, could you help me close this candidate? I know you're not involved with my company, but can you just help out? Sure, of course, right? And then later in life, you get rewarded for saying no because of what you just mentioned, right? You have not only so many opportunities, but you get a lot of inbound for things that don't matter simply because people want to inbound you versus because it's useful to them even necessarily. And so then you have to switch into a mode of saying no. And I think where people often lose a year or two of productivity is learning that transition from default yes to default no. And then the hard part is how do you still maintain enough yes so that you're still involved with innovative new things and interesting new people and the creation of new important aspects of technology or whatever you're excited about. And so I think that's one of the hard transitions I've seen multiple people go through, and some people have done it really well and some people have done it less well.
Well, maybe slightly different kind like one of the things I struggle with is I think when you're younger, like you get rewarded from determining like the difference between good opportunities and bad opportunities and to jump on the good ones. Uh, as you have more success, if you just keep going after the good opportunities, you're gonna stay at a local maxima. And what you really want to do is try to avoid those good ones and go for the great ones, which are really rare and often the great ones are disguised as bad ones that come in, and so it's very hard like to process that because it's like it's like oh will you join my board that's a good opportunity like it's almost certainly not going to be a great one or will you do this kind of thing on the side or something whereas this thing that looks like it has a lot of hair so how do you look for those.
It's a really hard question. I think fundamentally, a lot of what I've been driven by is what do I think are interesting technology or where do I think interesting people are doing things?
So at least
And
you're going to learn a lot of something interesting and
yeah, like I'll give you an example. Like, I think I got onto the generative AI wave reasonably early. I started exploring it, maybe 24 months ago or something. And so I ended up investing in a lot of really early things like Character and Perplexity and Harvey and a variety of other companies that I think are really exciting now. And part of that was because I'd been doing AI stuff for a long time, but part of it was, 4 or 5 years ago, maybe longer than that now, I got really into the GAN based art, and I just started doing a deep dive on it because I thought it was like really cool, right? You can generate art with,
yeah it's amazing.
AI
Yeah.
learning off of things and all this stuff, and
And by the way, I've seen your Twitter posts on it. Like you're actually really good at generating. Like you understand the prompts, and you've gotten really good at it yourself.
oh, it's nice of you to say. I don't know if that's true, but like I think, 5 years ago, I was really deep in this stuff just because I thought it was neat. And I was thinking, do I start an AI art studio and work out of it? Or, like I thought it was super cool
Yeah,
stuff. And so then when the generative wave came, I was more predisposed to it, I think simply because I'd already been down that rabbit hole. But before it was actually relevant to be down the rabbit hole, but I think I was down that rabbit hole because I thought the technology was really interesting. And then I thought the art output was cool, right? So it wasn't, what's the next thing and what's hot. And, it was just like, oh, this is really neat. And so I think like if you keep that mentality, that tends to be a pretty good driver assuming you have reasonably good taste on what's neat. Or alternatively, if you take a people lens on it, you're like, well, where are just really smart people building? And usually there's something there. Not always, right? Like there
Yep.
was tech waves and there was, IoT waves and things that weren't that interesting in hindsight, right? Or they were interesting, but in different ways. But I think that's a big part of it.
Oh, this has been great. Okay, last question we ask all of our guests. What conventional wisdom or advice do you think is generally bad advice?
It's a good question. I think in general, people's assessment of risk is wrong. And I mean that at every level of society. And that means everything from should we use nuclear, which actually turns out to be an extremely low risk, low impact technology if you look at, deaths from
Yeah.
nuclear over time or whatever. Or even things like car seats. I don't know if you've read the data on, at what age do car seats actually matter? There's some really good Freakonomics blog posts on that, right? Where
Well, I actually don't know that. What is the data on it?
what would be your guess? Like, after what age do car seats no longer matter? If you look at retrospective
Well, now
data
that
of
you're
actual
bringing it
accidents.
up, I would say 2.5 because before I would have thought it was 6 or 7.
Yeah, it's somewhere around 2 or 3. I can't remember the exact number, but you could just look it up, right? And it's been
Wow.
reproduced on
Okay.
multiple
Interesting.
studies. And so, and in the state of California, the age at which it's recommended keeps going up and up. I don't know what it is now. I'm making it up, but like it's age 11 and you're still in a booster, right?
Yep.
And so, and then people look at correlation between number of car seats and whether you have kids or not. And on average, you have fewer kids if you're forced to have more car seats, and that may or may not be causative, right? There's all sorts of correlations, but
Yeah.
it's a pain in the butt to like deal with the car seats, and can you
Totally.
really fit
Especially when you
the
travel,
third
it's like,
one and all this stuff? Yeah.
yeah.
And it seems like it's roughly unnecessary after a certain age, right?
Yep.
And there's lots and lots of things like that in society. So one is we're really bad at cost benefit analysis, and we're really good at safetyism and regulation in ways that don't necessarily help us. And that ties back to the pharma conversation too. It impacts drug development, it impacts all sorts of stuff. So there's a society level version of that, and then there's the individual level version of that. And the individual level version of that is basically what sort of risks are you willing to take over the course of your life, career-wise or otherwise? And how do you think about risk taking at every single moment? And are you actually making correct decisions relative to risk or perceived risk? And so I think most people really misunderstand what risk is, and they misact on it. And it has all sorts of implications, both for them personally as well as societally.
Yeah, there's certainly a lot of career decisions where the downside is extremely limited and the upside is exponential, and people call those things risky. When to me, risky is like jumping out of an airplane without a parachute. That's really risky, and I would never do that. Whereas like starting a company is actually, in many cases, extremely low risk, and you could quantify the downsides, and they're quite limited.
And you can almost argue the opposite, that there are moments in time where the risk is not doing it, but you
Correct.
misinterpret that, because the older you get, the more cruft you accumulate in life. And cruft isn't necessarily a bad thing. You have kids, but there's also the bad things, like your family members get sick and you have to help with
Yep.
that.
You have
Or
responsibilities.
yeah, responsibilities tend to accumulate with age. And I actually think that's one of the reasons why there are more young successful founders than older successful founders. Part of it is just raw opportunity cost. Like at some point it gets too expensive to do a startup. But the other piece of it is all that other stuff accumulates and just starts eating away time.
Yeah.
And so I think that's really misunderstood as a risk in life, is your time is going to go away.
All right, this has been amazing. Thank you, Elad Gil, for joining us on World of DaaS. I follow you at Elad Gil on Twitter. I subscribe to your Substack. I definitely encourage our listeners to engage with you there. Thank you. This has been awesome.
Oh yeah, thanks so much for inviting me. Really appreciate it.